what we're going to be going over here is governmental accounting, looking at the budget versus our ledger accounts. And what we're going to really be looking at is the control feature here of our budgetary entry. And this is going to be found really in our subsidiary ledgers here. So at any time during the year, the actual amounts can be compared with the budgeted amounts. So the first thing you're going to do, you're going to have your budgetary accounts. You're going to record the budget here. You set it up at the beginning of the period, you close or reverse it at the end of the period here. And there's never going to be any impact here on the fund balances themselves. There's going to be no actual transactions recorded in our budget accounts. So what we're going to be looking at here, so let's just start out with this, our budget items here. Looking at the control feature here is because they're going to have an opposite debit and credit, increases and decreases from normal entries here from our ledger accounts, and our ledger accounts here would be normal entries here for accounting. So let's go and let's look at what we're looking at here. So first for our budget here, we're going to be showing the inflows over here on the left hand side in T account form, and the outflows here on the right side. So let's look, first off, let's look at what we're talking about here for this control feature here. So opposite debits and credits here. So for our budget here, let's just look at our estimated revenue control here. So that's really the revenue that we would be receiving here by this governmental body. And what we have to do is we have to really compare it to the revenue control here in our ledger accounts. This is all the revenues that are going to be coming into this governmental body. So just looking at our debits and credits here. So typically with a revenue here, you're going to have a credit plus, debit minus. But when you record the budget, it's going to be just the opposite here. For the estimated revenue control here, you're going to have a debit plus, credit minus. So you can see they're just the opposite here. So not to be confused with it, but let's understand that when you're recording the budget, you have to set it up in that fashion here. So when you have all your accounts and you're really dealing with all the revenues here of the in your ledger accounts and so forth, then you use typical debits and credits here for revenues. So let's just look at what we're talking about. Well, first off, let's just go through this budget and then we'll come back to how our controls work. So for the budget here, our inflows, we're going to have estimated revenues here, and we're going to show an amount here. That would be a debit plus over here, and then our estimated other financing sources, debit plus, credit minus. So that would be our inflows here. Now let's just move over to our outflows. We're going to have our appropriations control here. That's going to be a debit minus, credit plus, and then we're going to have all our estimated other financing uses here for the budget. Again, debit minus, credit plus, and then at the end here, we're going to have to come up with a budgetary fund balance here for the budget itself. So we'll look at that in little detail here, but let's understand what we're talking about, this control feature, and how we can compare our actual amounts at any time to the budgeted amount. So let's look at it. Now, what we would do here, let's first off understand what's going into our revenue control here and our estimated revenue control here on our budget. This is budgeted amount. That's only what we budget here. No transactions are actually ever going to take place in your budget. But let's go over here and let's look at it. So again, revenue control, we're going to have the normal convention here for debits and credits. Debit minus, credit plus. So when we're talking about revenues, those would be any inflows that increase that do not have to be repaid here by the governmental body. So let's just look at what we're talking about with our control feature here. Say, for example, we estimated here that we're going to have estimated revenues coming in here of $500,000 debit amount here. But now let's just say at currently here, it could be at the end of the year or anytime during the year here, we have a credit of $475,000. So our revenues have increased in here in our ledger accounts, and we'd have numerous ones. So let's just say this is the total amount here for all those revenue accounts, $475,000. So it's easy enough by just looking at this opposite credit debit sign convention here to make the comparison here to the estimated revenues here, budgeted amount. Let's just say we had $500,000 here, and now up to currently here we have a credit or $475,000. So our revenues here have increased to $475,000, and our budgeted amounts we have a debit here of $500,000. So easy enough just to make the comparison. You can see there's a $25,000 difference here where our revenues that we actually have at the time here are $25,000 less than the estimated budget that we have. But just looking at our debits and credits here, and You wouldn't actually be making this transaction in our budget amounts, but just to see how it works. It's kind of nice here, this feature. So let's just say with a $475,000, let's just close it out here. Debit it here for $475,000, and for comparison, debit decrease here would be a credit, decrease here in estimated revenue of $475,000. So putting it into the computer or whatever, you're going to come up with a $25,000 balance here, debit increase. So your estimated revenues is still $25,000. There's no actual transactions. I'm doing this for demonstration purposes, and just to see how this is how we can use this to determine our budgetary fund balance at the end. So we've made our comparison here, and you can either do a side-by-side comparison, or you could run it through, say you had the computer here, whatever, you made your entry. So I'm just showing this here for normal accounting, how you debit or decrease one account here and also decrease the other account. So you can see $500,000 here, debit amount here in our estimated revenue control, credit reduction here $475,000, so we get a balance here of $25,000. Okay, so let's move down to our estimated other financing sources here in our budget. Now, that would be compared to our other financing sources here in our ledger account, and I'm just going to show them for currently here for all those other financing sources here in our ledger accounts. So what we're talking about here, this is where we're going to have the source inflows, and that would be like issuing long-term debt, selling capital assets, or any inter-fund operating transfers in here. Okay, so let's just look at our example here. Say for our budgeted amount, we're going to have estimated other financing sources here of debit amount here for $300,000. And then our other financing sources here in our ledger accounts, we're going to have a credit increase here of $275,000. So that's for our current here. So you can see side-by-side comparison here. You can see our other financing sources here are $25,000 less than our estimated other financing sources here in a budget. Easy enough to see here. But if we're going to make the comparison, it's not all, the reason we use this here is because you're going to have all these different accounts here, and you're going to total them up here for all your other financing sources and your ledger accounts, and then you can make the comparison to your budget account. So going back to our convention here, we'll just say, let's close our other financing sources account here, debit it here for $275,000, so the credit would go to estimated other financing sources here in a budget of $275,000. So you can see our credit here reduces our $300,000 debit amount here down to $25,000. Side-by-side comparison, it's easy enough to say, but running it through our debit and credits here, closing out one account here and making the adjustment here in our budget, you can see we got a $25,000 balance. So we still have estimating other financing sources here, $25,000 here greater than the actual ledger accounts that we have here. So what you want to do here, just remember, you sum your accounts here in your ledger accounts here, whatever amounts you have in those, and then you can make it a comparison to the budget amount. So visually it's easy enough to see here, easy arithmetic, but if you have to go through any number of accounts here, then you might want to put it in this T account form here, and then make your closing entries here and transferring it over to your budgeted amounts to determine what your balance is here. Okay, so we looked at the inflow side here. Now let's move over to the outflow sides here, and we'll start with our appropriations control here. And this is we're going to have the appropriations control here in the budget, and then we're going to have those estimated other financing uses here in the budget. So that would be the right hand side, again looking at in T account form here, and those are the outflows here. So again, the sign convention is the opposite here. So appropriations control, that matches with our ledger account totals here for expenditures control here for our ledger account. So appropriations would be really our expenditures here. So looking at our opposite convention again, you can see the expenditures control, that's typical of what you'd see in accounting here. Debit would be an increase, debit plus, credit minus. But in our budget, our appropriations control account here for the budget, just the opposite, debit minus, credit plus. So you can see the difference here, and you can see why we would use that here. So again, our expenditures control, That would be normal convention for expenses here when you're dealing with normal accounting here. And when we're talking about, let's first look at this expenditures control. That would be the expense outflows. That would be anything authorized here, any authorized legislative expenditures here by the government body. So that, but they have to be authorized, those expenditures here. So that would be our expense outflows here. So looking at our example, our appropriations control for a budget, say we had a credit, or we budgeted $450,000 here, and now we make the actual or the current comparison here for the actual amounts. And this would be all those accounts here for our expenses here for the governmental body. And this is, say, debit here was $525,000. So you can make the side-by-side comparisons. You can see your appropriations control here, $450,000 is what? $75,000 less than what we already spent to date here, the actual amount. So just going through our debit and credits here, let's just close out our expenditures control, credit it here for $525,000. So the debit would go into appropriations control here of $525,000. So what's sitting in our budget here, and remember, there is actually no real transaction going on here. I'm just doing it for demonstration purposes here, and you'd want to do this here just to go through your regular debits and credits here. And that's why we have those opposite debits and credits. So when we're talking the difference between our budget and what we actually have for expenses and revenue. So going back to our situation here, we have credit at $450,000 here sitting in our appropriations for the year here, but we already spent here $525,000. So we have a debit or a negative balance here in our appropriations control of $75,000. Okay, now let's go down to our estimated other financing uses here. So that would be, again, our outflow here. Let's say for the period we credited or we had budgeted $275,000. Now other financing uses here, we have a debit of $300,000. So first, let's just go understand what's going into our other financing uses here, our ledger accounts and versus our budget accounts. So what we're really looking at here is source outflows. That would be interfund operating transfers out and other governmental funds here for any sources. So that's any financing uses, excuse me. So let's just say for the period, let's go back to our problem here. Currently, we have $300,000 debited here in our ledger accounts, and then compare that to the credit or our credit here in our budget here for our budget at $275,000. So you can see we're sitting here uses we've spent, or we have other uses here. We spent more than we actually budgeted here by $25,000. So going back to our debit and credit, closing our convention here, let's just say we close it out, credited here, other financing uses, credited for $300,000, estimated other financing uses here in our budget, debited here for $300,000. So you can see the balance that's sitting here in other estimated other financing uses is $25,000. So we have a negative balance here. Okay, so you can see how those debits and credits work here, and I'm just showing it. There's actually no transaction going on here, but I'm showing it so we can make that comparison to what we've actually, in this case, spent to date here, or our source outflows versus what we budgeted. So we're sitting here with a debit amount here of $25,000. Okay, so all of that is done here. So let's go down again. You sum your accounts here and you make your comparison here. You sum your accounts for your ledger accounts here for these expenditures and your outflows, and then you make your comparison to actually what was budgeted here. So, okay, so let's go down and, okay, first before we do that, let's just make the statement here. You compare your budget, your accruals here, whatever in those expenses and revenues here. We looked on the revenue side. Here we're looking at the expense side. You look at whatever you accrued to date here, and you compare it to the budget amounts that we have budgeted for the period. And we looked at that here. And this is where you're going to get in that variance analysis. So you can always be looking at your budget versus your accruals, or what's actually spent in this case here to date, looking at it any time during the year here. So that's why we set up this different conventions here for our debits and credits between on our budget here, or our debits and credits on our budget versus our actual revenues and expenses. Okay, so now we've got down, let's look at the case here where we come up with this last account here, budgetary fund balance for our budget. So this is where we're going to look at our inflows versus our outflows here for the budgetary fund balance. So all of what we've done here, we can boil it down to our last entries here. So if budgetary fund balances, let's just say for the case here for our budgeted amounts, we're going to have a credit amount here of $75,000. So that's going to be where we have a greater inflow or less outflow. And how do we get up the credit amount here? That is saying that our outflows here, let's just look at what we're talking about here. So for the budgeted amount, say we had $500,000 here on our inflows for estimated revenue control, and estimated other financing sources, we had a debit here, $300,000. So what are we sitting with? Total amount here of debits of $800,000, and that's revenues, inflows coming in here for revenues here, and then compare it to our outflows for expenditures. We had $450,000 here plus $275,000. So whatever that adds up to, we had to, our inflows here of $800,000 are greater than our outflows here of what it would be, $725,000 here. So we would credit our budgetary fund balance here by $75,000. So our credits here have to balance with our debits here for our budget. So okay, so fine and dandy. We determined here initially when we budget our amounts, we're going to have a $75,000 greater inflow here or less outflow. But now when we went and we made our comparison here, comparing our actual amounts to current amounts here to date to the budgeted amounts, we come up with all these numbers here, any increases or decreases in those accounts. So what it all boils down to here, we can look at it in these terms here. Let's just say looking at our inflows here, our revenues, we had $475,000 here plus $275,000 here for our amounts, whatever that adds up to. We compare that to the other side of the equation here. We had a debit here for our expenditures, $525,000 here, plus those source outflows of $300,000 here. So what are that up to? $825,000 here. So we have $825,000 here, and I would think this adds up to $750,000 over on our inflow side here. So we have to come up with a debit. We're going to need a debit balance here of $75,000 here. So for our budgetary fund balance when our comparison date, we're going to see that we have to debit it here for $75,000. So that really for our balancing entry between our estimated revenues, inflows here versus our estimated expenses or outflows here. So this is the case where we're going to have a greater outflow here. You can see it of $75,000. And this is where we're looking at our ledger versus our budget amount. So we went through a whole bunch of numbers here, but you can see where this comes in handy to determine what you have for each of your different accounts for estimated revenues on your budget here versus the actual expenses. Appropriations control here, what you have for your expenditures versus your actual budget here. Appropriation control is the actual budget, expenditures. Well, appropriation control is your budget amount, expenditures would be the actual amount. And the same for your estimated other financing sources here versus your estimated other financing uses here. And then you can just do your arithmetic here for your debits and credits, and you can determine what you're sitting with here for the end of the period here, if you either under budget or over budget. So you can see here, if you have a greater inflow, you're probably a balancing entry in your credits here, you probably have a less outflow here, so you'd be over budget, whereas in this case here, budgetary balance where you have a debit negative balance, you'd probably have a greater outflow, so in this case you'd be over budget here. So okay, so we made our point here. Just go back and look at it again here. You can see we went through a lengthy example here, but when you're actually setting up your budget here and you're looking at your debits and credits, remember for the budget, any inflows here as estimated revenues or estimated other financing sources, a debit would be an increase, debit plus, credit minus. And just remember that is opposite whatever your normally revenue accounts would be in any other financing sources. It comes with those debit minus, credit plus. And those is really be your typical revenue accounts here when you're looking at accounting. And then just moving over to the other side here, just remember your outflows here, that appropriations, control, and estimated other financing uses. For the budget, credit plus, debit minus, versus the actual ledger accounts where you have your expenditures and your other financing uses, debit plus, credit minus. Okay, so we went through all these examples here. Just remember you have to set up your budget. There's no actual transactions going in those budgetary accounts. I just did this here for demonstration purposes here, just to look at how it would work. So you go through each of your accounts, make your comparison. You can either do a side-by-side comparison, or you can do these closing entries to come up with your ending balance. And then after you do that, just compare all your inflows with your outflows to determine what your budget fund balance would be for inflows versus outflows, for what you budgeted versus what is currently going on here. So inflows versus outflows, that is really what we're looking here for our budgetary fund balance. Okay, so that'll summarize our topic.